That was something else.
All right.
I really liked this one a lot.
Yeah, Mike is great. What was your favorite highlight?
For sure, the one where he talks about America's passion for the engineering talent of our future.
Yeah, let's play that clip.
I firmly believe that with the engineering talent we have in our network, that if we do 30 investments over the next 5 years across 2 funds, and none of those companies are worth multiple billions of dollars, then forget about returns. I think America suffers because we've now taken all that engineering talent across those 30 companies and we haven't created $1 billion plus of enterprise value. That was just bad capital allocation. And I can't envision a future where we take the scarce resource of engineering talent that we have in America and don't point it in a direction that's exceedingly valuable. I believe so firmly in that I made this my career. This is going to be my job, to find these people, help them build those businesses, and in turn, push us forward as a country and competitiveness globally. It comes from the brain power of the engineer. That's the broad arc of Also Capital is, hey, find these great engineers, put them all under one roof, working on a problem that matters, help them find the capital. And we don't have to be the only ones doing it, right? But that's the why for the next 10 plus years is there's a huge opportunity to go do that. And there's nothing more inspirational than seeing a Starship launch to tell people the time is now.
And his pronouns are USA.
What a guy. Okay, let's get into the show. Mike, welcome to the Slice Pod, where we uncover the stories of fresh emerging managers across the early stage venture landscape. You're the founder and general partner of Also Capital, a 22 million fund investing in the new generation of exceptional pre-seed to Series B hard tech founders. Let's begin where we always do around here, which is how do we get here? Was this always the plan?
The short answer is no. I don't think I always thought I was going to start my own fund. Close to a decade now, I've been an entrepreneur and I've optimized for spending quality time with high quality people that inspire me, people that have fun, people that are ambitious and trying to do truly incredible things. This seat that I'm in now and what we're building here is really about scaling up our ability to take my learnings and the learnings from our network and our experience and help catalyze the next generation of great hard tech entrepreneurs building engineered solutions that will drive society and the world forward. And that means things like space manufacturing, nuclear reactors, better communications infrastructure, robotic brain surgery, all these kinds of big, bold ideas. That's really what drew me here. I've been an institutional investor, founder, and now a VC. I think this seat that I'm in now and what we're doing really has a chance to help me have a bigger impact on the world. And I think build really strong relationships with super smart, ambitious people, which is the most fun thing that I get to do and is a privilege.
But you started as a founder, first and foremost. You were the CEO of Father Farms, which was building some weird, complex, ambitious method to make fresh food shelf stable and make it last longer.
Yes. We started Farther Farms, me and my co-founder, in 2016 when I was in business school at Cornell. We took that technology my co-founder was building in his food science master's out of a lab at Cornell in 2016, 2017 through Series B that we closed about 18 months ago and built out a 25,000 square foot pilot plant, hired up 30 people, fully vertically integrated, did everything from product development, process development, system design, integration, operations, product, go-to-market, marketing, the whole kind of thing end to end. And it truly has tremendous potential for the food system. We basically are developing the next generation of canning or retort thermal processing for food products. If you've had like pouched beans or canned beans or whatever it is that are shelf stable, we've come up with a new method that uses high pressure carbon dioxide in place of steam or hot water, which gives you much higher quality product, same extended shelf life, flexibility in the supply chain, and totally new product development capabilities and potential. So we spent 7 years doing everything end to end. And I think we took a technology that was in a lab through to a commercial product in 5 years for a novel food process technology. It took microwave technology upwards of 30 years for that same thing to happen. I'm not afraid of taking very hard technical engineering challenges and building systems and organizations to commercialize those quickly.
What was the aha moment that compelled you from switching from being an operator, founder of your own company, to the capital allocator, to the other side of the table? I'm sure that you negotiated your fair amount of term sheets and financing rounds. What made you say, oh, hell yeah, I want to be on the other side? Sounds fun.
So far, we've raised 3 rounds of capital at Farther Farms. I led and helped negotiate all 3 of those rounds. In a prior life, I was an institutional investor at the Cornell Endowment. I helped allocate close to $1 billion over 3.5 years. I've been part of investing in funds and co-investments. I think I bring a different perspective to early stage investing. I'm very much like an entrepreneur in a VC's body. When founders work with me, they definitely feel that the energy that I bring to investing in companies, to helping build companies, that's what founders want. I think there's an opportunity to build something generational in this category of hard tech that I felt there was a moment right now. And we had such great success with Farther Farms to get it to the point where it is, close a B. We had a really awesome new partner that we brought into the business, very clear plan for how it's going to grow and commercialize. At the same time, what had been a bit of a hobby, investing, was starting to take off, and the market was starting to turn its head and say, hey, this is really interesting. Like, this could be the future. And we had been living it. I said, I need to do this full time because this is the next step in being able to help more people, make more impact. That's what drew me to it. And started having conversations about raising more capital to put more dollars to work and backing the smart people that we're fortunate to have in our network, and was able to get it done a couple months ago. And now we're in a really good spot with our first fund. We've already got 6 companies in the portfolio, with building on the pre-month track record that we have. A company like Varda and Any Signal and a couple others.
Is there anything from that founder experience that you're taking through in your emerging manager experience as well? Besides the relationship with the founder, obviously that's a massive help to be able to relate to a founder. But in the way that you allocate the capital, in the way that you evaluate an opportunity, do you feel that entrepreneurial background brings a different edge to your craft?
I think it's
today?
just the confidence that comes from having been an operator for 7 years. And, what was unique about my operating experience and my founding journey is, no offense to anybody that started a hyper successful B2B SaaS business that was sold a few years later, but building a company in the physical world with complex IP considerations, that's an N of 1 company. There's no comps for it. It's a company that investors are not used to seeing and underwriting, and having to have that hard sell consistently for 7 years, building a diverse team across production operations, food science, regulatory, complex engineering, go to market. You're thinking from first principles for a lot of it. And that is a consistent theme you see in a lot of hard tech companies. I think that's one of those things that differentiates me as an investor in what we look for in our companies, and as an advisor after we invest throughout the life cycle. That difficult journey of building one of these hard tech businesses makes me more empathetic, confident in the advice, understanding of the challenge of being a founder, but also puts myself in a position where I feel comfortable holding founders accountable. And I think that dynamic just makes me a better coach, mentor, or investor, because we can get more out of the founders that we back, and they respect the experience that I've had, because I talk about specific examples of my own prior experience and the ups and downs of that over the last 7 years.
The space that you operate in has been growing rapidly, at least from an investing standpoint, over the last couple of years. I'm not saying that most of your peers are the platitude giving kind of guy. There is a lot of hard tech investors that are extreme value add, but there's definitely not that many that skew on the younger side that have a fresh, relevant operator experience. Do you find yourself competing against the juggernauts, or are there other smaller funds that you duke it out? Because you do lead deals. This is one very important thing to say about your fund.
We have super high conviction. I'm not afraid to write the only check and wire, and we'll find the rest of the money, because I think the team just needs to start executing and showing momentum. I'll take the risk alongside them. And we have a ton of conviction and confidence through my own advisorship and folks in our network. We can increase their odds of success dramatically. That's something we try to do, but we do it very selectively. We run a concentrated book, 15 companies. There's not enough capital in this space still. There needs to be way more capital in this space than there is right now. I'm cautiously optimistic that in the coming years, the asset allocator community will open up to the idea that this hard tech thing is actually a little bit distinct within venture and deserves its own bucket of capital to be permanently allocated to it as a strategy, which is a little different than thinking about it as broad venture. In the same way, a lot of LPs think about life sciences as a parallel partner category to traditional technology venture. I think there's the potential that they think about this hard tech category very similar to how they think about life sciences, where it's got its own allocation. And if that happens, there should be a flood of capital that will come in. So I think it is one of those things where rising tides will lift all boats. I think the best opportunities at the early stage are made. They're not seen. The best opportunities have come inbound to us, and then we move quickly and we're the first ones to get it going, or we meet somebody who we think is really special on a couple dimensions, and we can help bring them into the venture community and give them that first check. That's an archetype of something that we've done really well. We can also play with the established potential repeat founders now dipping their toe into hard tech if that's an area that's interesting. So for us, I tend not to think about how do we win. I think about how do we make sure that there's enough capital so everybody can win, because the dynamic for these hard tech companies, SpaceX is a $250 billion company. Tesla's an $800 billion company. You could look at companies that are, like Illumina, very big company. Intuitive Surgical, $190 billion company. There are lots of big companies that leverage hardware and software at the intersection. If you can find one, they can compound for a while. There's a lot of room for people to win. I think that's where the market's going in this category. Look, I think the biggest reason I'm excited about what we're doing here is we can talk about the tactics, talk about the company's strategies. I generally believe that the next 10 years of innovation is going to come disproportionately from people in our network and from people that are building at the intersection of hardware and software. AI is great. It's going to do a lot for the world. I think it's going to make a lot of really awesome stuff. But you need innovation in the world of atoms. If we can catalyze capital and talent into ambitious projects using the pool of capital that we put together, that's a dream. And I think it's the right strategy. You and I talked about this a little bit. I firmly believe that with the engineering talent we have in our network, if we do 30 investments over the next 5 years across 2 funds, and none of those companies are worth multiple billions of dollars, then forget about returns. I think America suffers because we've now taken all that engineering talent across those 30 companies and we haven't created $1 billion plus of enterprise value. That was just bad capital allocation. I can't envision a future where we take the scarce resource of engineering talent in America and don't point it in a direction that's exceedingly valuable. For me, I believe so firmly in that I made this my career. This is going to be my job for the rest of my career, to find these people, help them build those businesses, and in turn, push us forward as a country and competitiveness global. It comes from the brain power of the engineer. That is the root of all of that competitive advantage. Our job is to be the first domino in that, or if the founder is the first domino, we are the second domino, however you want to look at it. That's the broad arc of Also Capital, is find these great engineers, put them all under one roof, working on a problem that matters, help them find the capital. We don't have to be the only ones doing it. We have plenty of other people we will bring around the table to help do it, or maybe other people bring us around the table for the next 10 plus years. There's a huge opportunity to go do that. There's nothing more inspirational than seeing a Starship launch to tell people the time is now. Let's go do it. That's why I'm here. That's what's exciting about this opportunity. I feel absolute privilege to be doing this, because when I look back in 20 years and my kids are in college, after college, I want them to be able to say, hey, these 8 products that we use, Dad and his friends helped build. As a father of 2 young kids, 4-year-old and an 18-month-old, that really is what motivates you. That's why I'm doing one.
Close to half of your fund at this point, it's institutional LPs, including some pretty big names, blue chip, top tier kind of endowments and foundation, as they call them, which is rare that they commit to a fund one or an emerging managers to begin with, let alone an emerging manager within the space that you operate in, which is not that obvious as the B2B SaaS kind of enterprise strategy that we're all very familiar with. But I don't think this was from the beginning, right? I don't think that you started this fund, this raise, having 2 institutional anchors backing you. How did that pool of capital come together?
Super grateful to have the support of institutional blue chip LPs this early. It speaks volumes of their conviction in what we're building and credit for the work they put in to get to yes on this. But you're right. Day one, we didn't have a bunch of blue chip LPs committing to the fund. People tend to be drawn to unique insight, conviction, authenticity, real relationship building over time, and feeling like what you're doing is differentiated. Sometimes that can take time and you just have to be patient. The best thing we did was we showed we were serious. We were closing and deploying for about a year from our first close to our final close, and doing exactly what we said we were going to do. We were finding interesting stuff. That interesting stuff was raising more capital partners. those companies were getting more cachet. I think all of those things start to tell the story like, hey, this could actually be the interesting one, and this could really be an interesting opportunity to go after. And it didn't hurt that a bunch of our pre-fund stuff continued to do well throughout the 1 year fundraise to drive momentum. But at the end of the day, I gave the joke, having been an LP at the Cornell Endowment in a past life, I'm one of a few folks that have made the leap from LP to GP in venture over the years. I used to advise some GPs on their fundraise when they would ask me because I had this LP experience. The thing I would always tell them is be prepared for the pizza parlor shop you used to go to when you were a kid to get a phone call from a reference if you plan to take money from certain LPs. The advice I gave myself was, hey, you need to be prepared to be very open. People will do their work because ultimately they're investing in you and your judgment and character. That takes time for people to get comfortable with. But if you are doing the right things over a long period of time and thinking long term and you can partner throughout your professional career and your personal life, it shows through and you'll attract the right partners.
How'd you find these people, especially the early ones? Was it just friends and colleagues?
Graduated in 2011, so I've been for 13 years now, and I've always been kind of a outgoing relationship building person, and I think those things truly do compound. I keep people updated on things that are going on in my life, and I share updates. I think I met one of my anchor LPs at a conference that I was nominated for by a friend who I met through another friend who I met from a student in a class at Cornell that I spoke at when I was an entrepreneur 6 years ago. So you can't really plan these things out. I do tend to think some people get luckier than others, and it's not an accident. I think some people just are naturally magnetic when it comes to attracting people and creating opportunity for others. And I think if you do that consistently, good things will happen over a long period of time.
Do you think that your LPs with this first fund understand your strategy, like concentrated principal bets, the hands-on support? Or are they taking a bet on you, or is it a mix of both? Do you think that there is a real appetite from the LP base for managers that are a younger generation with operator background, looking in niches that are not so obvious? Or is it more the years of observing you and seeing that fire burn and being like, you know what, whatever Mike does, it's going to be fine?
At the end of the day, my job is to make money for our partners and to justify the risk that they take investing in our fund. When I tell our partners, I didn't get into this business to have a second quartile fund. I didn't get into this business to be above average. I want to be the best. And I want to back the best founders that are out there. And we're going to take the right level of risk to try to be the best. That idea, I think, resonated with people. I think it was refreshing for them to hear an energy in a GP in a category that they understood and had a bit of an early proven track record to say, hey, we believe so much in what we're doing that we're willing to run concentrated. We're willing to make big bets. We're willing to be early and be first. It's very much putting your money where your mouth is and eating your own cooking. I think that dynamic among certain LPs is appreciated and valued. There's a lot of LPs out there in the world and everybody has a different strategy. You have to play your own game. You have to have confidence in what you're doing. The minute you try to adjust yourself to appeal to an LP, it's not going to work. This strategy we're running for this fund is very authentic to me. Authentic to the track record we've built, to the brand, to the alpha and the edge that I think bring to the market, being able to find things early because we're very approachable to engineers, having enough credibility that investors respect our early check, and we have enough experience to help counsel founders after we invest, and also diligent stuff on the front end to make sure we know, is this a venture scalable idea? We can answer all those questions in a very unique way. As an operator, I have a bias towards wanting to spend more time and be more of an investor and a capital allocator. And our LPs, it's a mix of people that have known me for 20 plus years and people that I met 4 months ago. At the end of the day, it's about communication, building trust, setting expectations, doing what you said you're going to do over a long period of time. That's something I spent the last 7 years doing as an entrepreneur. Something I spent a lot of time reporting into head of private equity and CIO at a large endowment. So I know how to manage stakeholders and set expectations. And
you say, like, to back folks who are serious people who don't take themselves too seriously. Why is that so important?
I think this
game is hard. The idea that you're going to take $2 million and in 7 to 10 years, create a business worth $1 billion or more, which is the base expectation for most VCs these days. It's actually insane how hard that is to do. If you're not willing to laugh at yourself and your situation along the way, you'll burn out and you won't get there. You either have it going in or you're never going to get there. Doug Bernauer is a great example. Doug Bernauer is the CEO of Radiant Nuclear. They just announced their $100 million Series C. We were the first investor in that company. Doug was one of the lead engineers on the Grasshopper project, which was the Falcon 9 reusability for SpaceX. We spent time with Doug before he even raised any money. He was very thoughtful, very pragmatic about how he was going to build a nuclear reactor. You could tell he was going to do it. He was committed. There was this dynamic where Doug was committed and confident, but he wasn't serious. He didn't make you afraid. He actually instilled confidence with his own conviction and commitment. If you talk to him, he's very down to earth. He can joke around with you. He has a clear way of how he thinks about it. I think that is very inspiring for team members. It's very inspiring for investors, and it's how you actually achieve big, ambitious things. You could argue that it comes from an Elon. Just look at Elon's persona. I don't think anybody would say he takes himself too seriously, but you can bet he deals with serious things all day, every day.
Where'd you find them? Do you go to the serious but not take it serious event, conference, summit, and hand out business cards?
It is a small pool of people, and you can get a sense of why we want to run pretty concentrated in the fund. I don't think more shots really increases our potential of catching one of them. I think they're very much made more than they are found. At different points in the fundraising process, you tend to get back the energy that you put out into the world. We try to make ourselves very approachable to some of the best engineers out there. We try to engage founders and engineering talent in things that they are interested in and be genuinely, authentically interested in what they're. We try to be long-term oriented and focus on how do we build the business, but also how do we stay true to the art of the engineering that they're doing. I think that reputation just compounds among the community. Engineers talk, founders talk. It's a small network of people that are capable of building these things. The unique difference about the hard tech category versus the software category is any two kids in a garage with a computer in Palo Alto can build a multi-$100 million business with relatively little capital. In theory, there's no bent metal to do. It's just two people. The more code they write, the more iterations they go through, the more customers they talk to, the more insight they arrive at. There's no marginal cost for them to scale. It's hard to hide your new 40,000 square foot facility. People know where you are, and generally there's far in advance of revenue or very early revenue when you're doing that kind of thing. These opportunities tend to hide in plain sight, if at all. The alpha is being able to help build opportunities in the early days and take exceptional engineers or exceptional engineering teams, more importantly, and coach them in the right direction where they may have a vision, they may have a plan, they can build the thing or they will be able to build the thing. Tweaking in the early days is really helpful. Can we make sure that we raise the next round of capital? Can we make sure that we have clarity on what the business model is? How do we make sure that this has venture scale upside?
You've touched on how quickly you can move writing checks to get there before the 40,000 square foot facility is built and it's under the nose of everybody else. Probably get the confidence of doing so by the relationship that you build with these folks and by seeing them execute over time. But have you built some sort of formula, some diligence pattern, or is it just intuition?
So from a diligence perspective, we always do our homework. We try to understand what is this technology? What are the competing options? Why now? Is this the right moment to be building this? Is the wind at our backs or in our face? But before that, we try to understand, is this the person who has the potential to hire a really great early team? That tends to happen within the first 12 months. If they can't get past that milestone, nothing else matters. And in hard tech, it's interesting because if you don't have the team, you really can't make progress. I think software founders can build more and show more before having a team than a hard tech founder can. Because if you're building a physical product and you don't have a mechanical engineer, you can't build the product. So it becomes about, can you hire? So for us, it's very much focused around diligencing the person on the other side of the screen or table and calling some of our friends, would you work for this person? Do you like what they're doing? Is this a problem you're interested in? Can you talk to them and let me know if you think they could hire a team? I think those are the things that we spend our time on more, because the reality is, if you're taking enough risk early on, the first technology you're building is not going to be what gets us to $1 billion plus outcome. There's going to be multiple iterations of it, and the team needs to figure out what those are and then go execute those. And you only get to build the team if you can raise the capital. You only get to raise the capital if you tell a story. So we bring it all back. It really just comes back to, is this a general zip code that's interesting to be building in? And then can we build a great team of engineers and tell a really compelling story that this is what the world is going to look like in 10 years? This is the first step on that 10-year journey, and we're the team. And that's really where we tend to spend most of our time. We'll make sure that what they're doing doesn't violate the laws of physics. We'll make sure there's at least a vision of how the business case can close or get to exponential revenue and high growth. We don't know exactly what that looks like, but for early stage investors, we can take the risk on what it looks like, but we shouldn't take the risk on, is it possible?
And you said at the beginning, you march at the beat of your own drum and you're not trying to conform to some other styles. Very much like an artist, you have to develop your own taste and your own style, your own handwriting. You've deployed quite a bit of the fund at this point. What would you like the next also capital to be known for from an handwriting perspective? Among all of the other hard tech capital allocators, what is the one thing that behind closed door you wish that people talked about?
I think there's no better test than if an LP were to meet any of your founders, they should be universally impressed. You take certain risks, sometimes it works, sometimes it doesn't. You make a bet on a market. That's what we get paid to do, to make those risks. When LPs meet our founders, there should almost be like an aha moment and a click, like, oh, that person is different. I get why Mike made that investment at that price. I get why so-and-so followed onto it. Like when you meet the founder, everything kind of slides into place. There's a Jeffrey Katzenberg quote where he says, not all our movies are going to be hits, but they're all going to be viable. That's venture. You can't compromise on your standards. All you can do is keep high standards on things you can control and be very well aware of the risks you're taking inside each business. Then you audit that. If a business works, why did it work? Did it work because of the risk we identified being de-risked? If a business doesn't work, did it not work because of the risk we identified? If so, you're doing your job. You're identifying the right risks and you're choosing the risks to take. You can't really control how they play out. You can increase the odds of success. But I think the number one mistake I see people make is they don't really know what risks they're taking. They don't know, if you're a founder, what is the implicit business or market risk you are taking with your business model, your financing plan, team you've built. If you're an investor saying, I'm going to invest in 30 companies, what is the risk you're taking? If you're investing in this category or this company, what is the risk you're taking on that company? What's a power law? Let's invest in a lot of companies. You could be more specific than that. What is the bet this company is making about the future? When you listen to Peter Thiel, he talks about all these philosophical things and 10 years in the future, because that is what matters for a lot of these companies. It's not private equity. It's not growth equity. It's not about quarter over quarter revenue growth. It is about a vision for the future that is informed by an understanding of people and what they want and need, and building today what they will need 5 years from now and being right. That's ultimately what we're trying to do. We just do it through the lens of hardware, systems engineering, system integration, those kinds of problems, because we think we're over-indexed on the group of talent in those categories.
From the LP side, I totally get it. I understand where you come from. I understand what you're doing. I understand that without you as a Sherpa, if I am interested in getting exposure to this kind of risk, I'm probably not going to get the returns I'm looking for. But for the founder, beside the capital, what is the core value add that you pitch them? It sounds like most of the people that you invest in have a very clear idea what you're building. They have a decent enough commercial plan of how they're going to take that to market. What is the bulk of your time spent when you do portfolio management with these folks?
I'd spent 7 years as a founder of a hard tech business. We've been first check investors in 4 or 5 of what I consider to be the leading venture-backed hard tech companies in the last couple of years. Our network of engineering talent is second to none in the prime of their career. I've been on the board of Artist since inception for the last 4 years, worked closely with Will and Delia, and I think that experience is valued by founders at the early stage. I can connect them to the founders of those companies that we were first checked into because we were very close. And I have LPs and engineers on our network that I connected to for advisory, introductions to talent. And I do it all myself and quickly as a solo GP. I think that's why we win, candidly. I think it's just reputation. Right? If you're paying fair market price for competitive stuff and people understand the track record and what you've done and the respect you have from downstream investors, I think that's really what a founder wants. Every founder is different. On our website, I intentionally chose the language for what we do. It's, hey, we could be hands-on, high energy, or we could write a check and get out of the way. I am not so egotistical that I need to help every single company. There are some companies where you can add a lot of value in the early days by counseling, coaching, And then there are other companies that it's better to just write the check and let the founder run. Knowing when to pull what tool from the toolkit is important. There's a compounding benefit. People considering me a resource that's always in their corner. We've structured our fund and our capital in a way that's consistent and alignment of interest with that. And I think that's the other piece of it that I think is really important is when you're only doing 15 investments and you're not really reserving a ton of capital, you're in the same bucket as the founder the minute you write the first check. There's no concern that you're going to negotiate against them in later rounds or downstream. So you get very open relationship, very close relationship. Helps make you their first phone call when they see an interesting deal from one of their friends and they want to send it to you because they want that friend to have the same experience they have. I really think it's just a long game. It's a long game, being a good person over a long period of time, making people money. If you do those things, you'll build a relationship.
I guess this is what makes you different from the big guys, is the fact that you're small enough that you are part of the team, not an antagonist on the cap table, especially when the game gets tough in the coming years. Are you going to keep it small? Is that the plan?
I'm going to do a Star Wars quote and say, only a Sith deals in absolutes. I started off at a very large family office right out of undergrad. It was really a hedge fund. You go where you can find alpha. You run the strategy that you think you have consistent edge, consistent alpha. To say, oh, we're going to do a $22 million fund, then we're going to do a $50 million fund, then we're going to do a $100 million fund, and here's how we're going to scale. If anybody has that clarity until they've actually played the game on the field and won, it's probably a lot of marketing, if I'm being totally honest. I love being in the business of building companies. I love helping think through the early days of what strategies should be run. I love being in the room, helping do a deal. Did a bunch of them in my company, and I've gotten decently good at it. You hit on serious people that don't take themselves too seriously. Have fun, play to win. If you're not having fun, it's really hard to do great things. If you're not competitive, not playing the game to win, playing it, you can play to win and not be having fun. That's not sustainable either. But if you can find the balance and have the two, that's where the magic happens.
This is not your first job. This is not your second job. You've spanned the landscape of venture across different environments. What is different about being Fund 1 solo GP? What's the hardest part about transitioning into this role?
I think the hardest part is the context switching constantly from different companies with different technologies and different founders and different needs to new investment, to operations, to legal. I'm moving all around. And I think we're in process of setting up the people and the processes and things like that to make my life a little easier. I'm getting better at triaging how to spend my time so I don't have to do as much of that. So the hardest part is when you go from the 6 companies we have to the 15 that I plan to have in the fund, that's more than 2x the number of companies. The plan is that you work closely with companies for the first 3 to 12 months and then they graduate and then get help from other folks from the next stage and have built that early team. That's a little bit of the plan. Probably actively working with 3 to 5 companies at any given time before they graduate to the next round. That helps manage my time as a solo GP. That when you're that close and part of all of it, you're physically raising the money yourself. You have a respect for the money that you have. It affects how you invest, driving up the conviction level that you need. Being close to the investments helps make you better at raising capital. Being close as a solo GP to both functions makes you better at both. There's a lot of ways to be successful, but speaking for myself, I find there's a lot of value, especially early on in the firm life, to be doing both, build relationships on both sides.
You said all the intros, all the follow-ups, all of the events, it's just you. You said we a couple of times, but it's just you. How do you keep all your ducks in a row? What's the secret sauce? Do you have a particular tech stack that we should know about?
Email, text. I use ClickUp for the CRM. I have a VA in the Philippines, Andrea. She's wonderful. She's been working with me for 18 months now. She keeps the trains running on time for me. I have a fund ops consultant that helps 10, 20 hours a month. I run on AngelList, so it helps take some of the back office stuff off my plate. I'm a phone call guy. It's just faster and it gets more intentionality across. I try to avoid long text messages, long emails. I just don't have the time. But I am home for dinner most nights, my kids and my wife, but I work after dinner, after the kids go to bed until 9, 10, 11, sometimes midnight, and then take my daughter to school in the morning, and then I'm working from 9 a.m. back to back. No breather. I don't look at the clock at any point in the day. There's just not enough hours. It's the way it should be.
And then they say that founders retire being venture capital.
I mean, that's an interesting subtle point though, right? Because when you're doing it this way, you have a respect for the hustle of the founder. And I think they respect your hustle too. They're drawn to that. At this early stage, when the first $1 million all kind of looks the same, you can get it from a lot of different places. I think they want somebody who's down to build alongside them.
They can relate to. I agree 100%. And we see this across the emerging manager set. It's one of the number one reason why you guys win. What's a piece of advice for future Mike? There is a founder out there raising their Series B, thinking one day they want to become an emerging manager. What piece of advice do you have for them?
I'll give them the advice I used to give other GPs in a past life. Pitch the firm, not the fund. Too often there's, hey, I need a bundle of money to run this strategy, versus this is why we need a new firm to exist. This is what the firm will stand for. This is the brand and the vision. And here is our first attempt at building that firm with this first fund, this size, with this strategy, with these reserves, and make it about you. I think that idea is a really important one. People understand that you're serious, that this is your business. And that is how I think about what we do. The fund is just the first vehicle capturing value we're creating. That's a mindset shift that really resonates with LPs when they see you're thinking about it from a multiple fund life perspective, but also understanding that you have to prove yourself to earn each subsequent fund. That's one of the things in my founding experience instilled in me. You're always proving yourself. You don't get away from that. That dynamic is tough for a lot of people to get comfortable with because you're constantly being evaluated. Every deal you do in your first fund is going to be evaluated. Every deal you do in the second fund is probably going to be evaluated pretty closely. Accept that and do the best you can do. Go win. If you don't have that attitude, this is a competitive game. Don't play.
I love it. This is great. And let's say I'm an engineer about to hit it, looking for some capital to kickstart a journey, or an LP that just listened to this and is like, oh, I like this guy. I'd love to be building a relationship so that I can get in this fund too. Do they just ring you up, or what's the best way to get in touch with you?
I'm super happy and grateful for our existing LP base. I understand the responsibility of what it means to manage money for people, like their hard-earned money, be it it's university or foundation or a high net worth or fund, whatever it may be. I take that responsibility really seriously. I want aligned LPs who understand what we're doing in terms of getting in touch with me. It's always great to come into an existing LP or a friend or somebody that I know. And that's the best way to make sure that you're in a good spot for Fund 2. I don't know if Fund 2 will be that much bigger than Fund 1. So far, things are going well in Fund 1. We'll see how things shake out for the next one.
Talk about ending on a bang. Mike, thank you for joining us. This was great. Love hearing your story, the explosive energy of your ideas and the companies that you're funding. I don't think this is going to be the last we hear of you. You will always be a welcome guest around the Slice table.
You've just listened to another episode of Slice, the podcast for emerging managers. This episode was produced by me, Sunwoo, and Fabri. Make sure not to miss next week's episode, where we'll have yet another very special guest who scaled customer success at a startup from $1 million to $300 million in ARR, and now has the largest community for customer success professionals. And you guessed it, built a fund around it. If you're already subscribed, make sure to share this with a friend. It really helps us out. And if you're new here, welcome. Make sure to subscribe to our Substack so you don't miss next week's episode. See you then.